Hello and welcome. This is your stocks to watch at BloombergQuint. I am Agam Vakil. Today we're going to talk about QSRs, Westlife Development, and Jubilant FoodWorks because we're expecting earnings from Westlife Development a little later on. We have ICICI Bank in focus as well as Vedanta. And to take us through these stocks, we are in conversation with Parthiv Shah, Director at Tracom Stockbroking. Parthiv, good morning, and thanks so much for joining in. But before I go across to Parthiv, let me get in and talk about the first set of stocks, in fact, if I can say that. We have Westlife Development as well as Jubilant FoodWorks. Now, from Jubilant FoodWorks earnings, we realize that, of course, deliveries have certainly taken over the chunk of the business because of the pandemic. And COVID-19 has also stalled expansion plans for a lot of these companies. At least in the near term, there does seem to be some pressure when it comes to growth, needless to say, because of the pandemic. But let's get in, Parthiv, into the conversation. Parthiv, good morning. Thanks for joining in. What's your view on Westlife as well as Jubilant FoodWorks? How would you go about approaching these?
Good morning, Agam, and thank you for having me on your show. So I think, Agam, if I were to overall talk about the QSR segment, and I'll also go in detail because we have the Jubilant Food numbers and awaiting the Westlife developers numbers. So what has happened is that, it was a challenge. There's no two ways about it. And if we look into the past quarter, at least till January and February, I think the same store sales growth run rate was quite normal. It's only in almost the second half of March that, it took a huge dip. And had to also take some sort of a write-off of around 123 crores due to some perishable materials related to the March ending quarter. But nonetheless, I think let's understand the overall scenario. What's happened is a lot of small mom and pop type of restaurants have kind of closed down. And I really doubt even after the lockdown being opened up, they'll be able to come back into the market. And right now, if you see the consumer behavior, it's more oriented towards the trust, hygiene standards, quality, and where they can have the conviction that at least, it's a process-driven organization. And that is where people like, say, Jubilant Food and even Westlife Development, which are like global franchises, global brands, I think they're trying to ensure to the customers that, have faith, our hygiene standards are state of art. And I think that's where I feel that going ahead, living with this pandemic, I think these guys are going to garner a lot of market share from a lot of unorganized players. Even if you look into players which are there listed on Zomato, Swiggy, they also used to give some sort of competition to both of these players. But now I think the trust factor is going to play a very, very crucial role. And if you look into Jubilant FoodWorks, I think almost 938 of their stores are operational, which covers almost 87% of the area. And the rest of the problem that they have in terms of non-operational stores or the areas which are not covered, again, they can easily cover that volume through some sort of delivery-based model through digitization. So I believe that in the long run, both of these players are very well placed. They are working on the fixed cost. They're trying to rework variable pays vis-a-vis fixed pays for their employees in an hourly basis pay. And they're also working in terms of their landlords to kind of revise the rental rate. So fixed cost is also an element where they're working on. So overall, I feel a player like Jubilant Food could come out stronger from such pandemic. I'll be interested to hear what does the management of Westlife developers say, because it's a slightly different business model in terms of the type of the food they offer. But overall, I think positive on these two spaces over the longer horizon.
Sure, fair enough, Parthiv. From there, we move on to ICICI Bank. Now, the news that we have on hand is not as influential to the stock, considering we have Apollo Global, which is looking to end its JV with ICICI Bank, and the firm seeks to start its own credit investments business in India. But the reason we took ICICI Bank was because it's one of the more important private sector banks in India, and we have to do that kind of discussion considering the kind of credit environment we are in right now. So, Parthiv, where do you stand on ICICI Bank currently?
See, no doubt, I think there are challenging times for even a banker like ICICI Bank. But I think if you look into their commentary, what they mentioned was that 30% of their loans in terms of value went into the moratorium. And I think beyond that, I think they are not worried that more loans will get extended. So that is, I think, quite a manageable show in terms of their loan book. And they're not worried. I think even their commentary clearly mentions that they're not worried that even that 30% which has gone into moratorium is going to create any sort of major asset quality problems for them. I think, in fact, they're a little upbeat in terms of the SME, MSME loans, where now there is some sort of guarantee from the government. I think that's the business that they would love to target, because once you have the government guarantee, over and above that, those are very high yielding loans. and ICICI Bank is sitting on relatively lower cost of funds. And in such an environment where the regional banks, these small finance banks are relatively losing market share in terms of their deposits, I think most of that market share is going to bigger players like ICICI Bank, HDFC Banks of the world, Kotaks of the world, SBI. So I think they are very upbeat in terms of their liability franchisee, the deposit growth, and we have seen the bigger players cut down on the savings accounts rate. And I think that's what even a player like ICICI Bank has done. So overall, the cost of funds will be good. No doubt, 1 or 2 quarters, the NIMs could be under pressure because they're sitting on excess liquidity, which is right now not yielding very high because they're being little conservative in terms of where to dole out the loans. But going ahead, I think these organized players, these big players in the banking system, are going to garner a lot of market share from the smaller NBFCs, from the undercapitalized banks. And I think that's where the futuristic growth lies. And in ICICI Bank, we should also understand the fact that it's always considered as a sum of part valuations type of a story. All its subsidiaries are relatively quite stable, doing well. So the core book, if I see, is not really excessively valued. I think it's valued at around 1.3 times forward price to book multiple. That's where I find comfort, and most of the negatives kind of factored into.
Okay. All right. And finally, let's talk about Vedanta. Well, we understand the Fitch Ratings has placed Cairn India on Ratings Watch. This follows the fact that Vedanta's intention to delist. Of course, that's the bigger plus point, perhaps what everyone is talking about, Vedanta's possibility of delisting. Based on this, Parthiv, what would you do with Vedanta?
See, tricky scenario, Agam, and I think in the management con call commentary, they didn't want to discuss about the delisting part.
Yeah.
And the floor price that they kept for the delisting came at around 87.5 bucks. And at that point in time, we knew that the trailing book value of the entire company as a conglomerate was hovering at around 180. And now in this quarter, they took a impairment charge of almost 17,500 crore, where bulk of it came from the oil business, thanks to the lower oil prices in that quarter, which have now rebounded. And over and above that, the iron ore and some other expenses that they're taken got the book value down to almost levels of 138, 140. So I think they're trying to align some sort of arrangement where I think the way they delisted Vedanta Resources in UK at a 20-27% premium, probably the management would try their level best to kind of even get this company delisted at a relative lower valuation. And I think the logic that one is sensing for the delisting is because Vedanta Resources, their parent company, is a private limited company. And if they can delist this company, the merger of the two private companies would be more tax efficient. Plus, they can use a lot of cash and a lot of cash flows from the Indian business to service the parent's liability. So I think here I feel that, investors will have to play out in a range of lower end of 90 bucks and on the upper end around 130 bucks. So that's where the valuation call will lie. But looking at the core business, I think, yes, oil was a drawdown, but going ahead with the oil prices improving, I think that could show some sort of positivity in terms of the cash flow generation. The zinc business is quite encouraging, and the major bulk of the cash flow comes from there. The aluminum business was a positive surprise in terms of lower cost because of local sourcing of bauxite and ramping up of volumes, at least until the last quarter. Now, quarter one is going to be a little challenging. And also, if I look into their iron ore business, that is also where they are struggling. So overall, I think the business environment is not terribly bad for Vedanta, but I think the entire story lies in terms of what value they wish to give for delisting.
Okay, Parthiv, I'm going to very quickly conclude by, taking you up on a certain call that you had given us last week, and that was an Idea Cellular. Back then, it was at 5.5 rupees. It's moved up to 12. So the stock is literally doubled in a span of 1 week. Of course, we also have the AGR dues issue coming up on the Supreme Court today. How would you address this at this point in time?
See, Agam, back then also had mentioned that if I were to be an investor in a stock like Idea, it's going to be like a long-term call option with unlimited expiry, and you know what loss you could sit on if at all this value were to go to zero. Luckily, it's kind of doubled down. I think if any people would have invested into it at levels of 5, 6, 7, I think I won't be hesitant to stick my neck out and say that it's not a bad idea to book out some profits, because I believe that there is little uncertainty in terms of the AGR issue, but I think it's really not a bad idea to take some profit off the table.
Sure enough. Well, that makes sense, Parthiv. On that note, I'm going to thank you for taking us through the various stocks that we've addressed today. And also, that's a wrap on this special edition of Stocks to Watch, but there's lots more lined up. Stay tuned to BloombergQuint.
Thank you.